Why reducing the number of decisions improves investment outcomes. In investing, activity often feels productive. More analysis, more trades, more adjustments. But evidence from behavioral finance and decision science suggests the opposite. Fewer decisions often lead to better long-term results. Here's why. 1. Every decision is a chance to make a mistake. Each investment decision introduces emotional bias, timing risk, cost friction, cognitive distortion. Research by Daniel Kahneman and Amos Tversky demonstrates that humans are predictably irrational under uncertainty. The more decisions you make, the more exposure you have to overconfidence, recency bias, loss aversion, confirmation bias. Reducing decision count reduces behavioral error frequency. 2. Decision fatigue lowers quality. Decision fatigue is the decline in decision quality after a long session of decision-making. In investing, constant monitoring and frequent trades create mental exhaustion, impulse reactions, short-term thinking. When cognitive resources decline, emotional responses dominate. Fewer decisions preserve mental clarity. 3. Trading costs compound against you. Each trade includes commissions, bid-ask spreads, market impact, taxes. Even small frictions compound negatively over time. As emphasized by John C. Bogle, founder of the Vanguard Group, minimizing costs is one of the few reliable advantages investors control. Less trading, lower friction, higher net returns. 4. Activity increases emotional volatility. Frequent decisions amplify stress, regret, performance comparison, narrative construction. Each trade ties ego to outcome. Reducing decisions reduces emotional attachment to short-term fluctuations. 5. Compounding requires stability. Compounding works best when capital remains invested, returns are uninterrupted, strategy remains consistent. Frequent decisions interrupt compounding through poor timing, partial exits, strategy shifts. Long-term investors such as Warren Buffett at Berkshire Hathaway demonstrate that sustained exposure, not constant adjustment, drives wealth accumulation. 6. Simplicity improves adherence. The more complex and decision-heavy a strategy is, the harder it becomes to follow consistently. Behavioral sustainability matters. A simple strategy with fewer decision points is easier to maintain, easier to explain, easier to execute during stress. Consistency often outperforms theoretical optimization. 7. Opportunity cost of attention. Attention is limited. Constant decision-making consumes cognitive bandwidth that could be used for research depth, career development, skill growth, long-term planning. Reducing investment decisions frees mental capital. The structural advantage. Reducing decision frequency. Lowers behavioral error. Preserves compounding. Minimizes cost drag. Reduces stress. Increases strategic clarity. It shifts investing from reactive behavior to structured discipline. Important clarification. Reducing decisions does not mean ignoring risk, avoiding rebalancing, refusing to adapt. It means eliminating unnecessary actions while preserving essential ones. Final insight. In markets, you do not get paid for activity. You get paid for correct exposure sustained over time. Every extra decision is another opportunity to interfere with compounding. And often, the investor's greatest edge is not superior insight, but fewer chances to make mistakes.